Imagine a snowball, small at first, rolling down a hill. Every turn it gathers more snows. Lowly, then suddenly, it's a massive force you can't stop. That's not just physics, it's wealth. And one man turned that snowball into one of the largest fortunes in history. Think about fire. You don't start with a roaring blaze. You start with a single spark. One small flame becomes a candle. The candle lights a torch. The torch ignites a bonfire. Wealth works the same way. Compounding isn't magic. It's math mixed with time, patience, and discipline. The core idea is deceptively simple. Your money earns money, and then that new money also earns money, creating a loop that accelerates over time. But here's the catch. Most people never see the full power of compounding because they quit too early. They want results tomorrow, and when they don't see them, they stop adding fuel to the fire. The secret isn't about timing the market perfectly, it's about staying in it long enough for the math to work in your favor. Imagine you invest $1, €0 at a modest 10% annual return. In 1 year, you've made $100. That's nothing exciting, but after 10 years, you're at $2, $593. And if you keep going, in 50 years, that same $100 becomes over $117, without you lifting a finger. That's the snowball effect. It starts small, but with every roll it picks up more momentum. Now picture someone starting young, not 30, not 25, think teenage years. Every dollar invested at that age has decades ahead to multiply. This is why Buffett didn't just stumble into wealth, he engineered it through time. He began investing when most of his peers were still asking for lunch money. That gave him an advantage you can't buy later in life, the multiplier of years. You can't rewind the clock, but you can maximize the time you have now. Compounding is like growing an orchard. If you plant trees today, they give fruit tomorrow, seeds the next day, and soon you're not just eating apples. You're selling baskets of them, then entire truckloads. The growth looks slow at first, almost invisible, which is why so many people give up before the magic kicks in. They uproot their trees before the harvest, cashing out too soon. But the ones who stay, they eventually reach a point where the money coming in from past decisions far outpaces the money they put in themselves. The orchard feeds itself. The brilliance here is that compounding doesn't require extraordinary intelligence or even extraordinary luck. It requires consistency and restraint, the ability to avoid the temptation of quick wins in exchange for massive wins later. Most people overestimate what they can do in a year and underestimate what they can do in a decade. Buffett played a different game. He was willing to wait. In a world addicted to instant gratification, his patience became a superpower. Every dividend he earned was reinvested. Every gain was left untouched to generate more gains. Over time, this created a runaway train of growth that no market crash could fully derail. That's the irony. Compounding feels boring at the start, but it becomes unstoppable if you let it run long enough. It's like launching a rocket. The hardest part is breaking free from gravity in the early stages, but once you're in orbit, momentum carries you faster than you ever imagined. The difference between a small investor and one of the richest men on earth often comes down to this understanding that the most powerful force in finance isn't a risky bet or a secret market hack. It's letting the snowball roll without knocking it over. When most people buy stocks, they're thinking like gamblers in a casino. They look at a ticker symbol, see if it's going up or going down, and try to guess the next move. It's like watching a horse race. You're betting on speed, not on the animal's health, strength, or breeding. That's not how Buffett played the game. He didn't see a stock as a lottery ticket. He saw it as a slice of a real breathing business. That means asking, if I owned this entire company, would I actually want it? Would the product still be in demand 10, 20, or 50 years from now? Does it have leaders who know what they're doing and care about shareholders? Can it survive storms, recessions, and industry shake-ups? Thinking this way changes your decision making entirely. You're no longer buying a number on a screen. You're buying an engine designed to generate wealth over time, and you don't want an engine that sputters after one race. You want one that can run for decades without breaking down. This mindset shifts you from being a trader to being a true investor. Traders chase quick moves. Investors look for lasting value. Buffett famously waited for the right pitch before swinging, meaning he didn't buy just because something looked cheap or exciting. He wanted what he called a moat, something that protects the business from competition, like a brand so strong customers wouldn't leave even if prices went up, or technology that others couldn't easily copy. Think of a business like a fortress. The best fortresses have high walls, deep moats, and well-trained guards. A company with those defenses is harder for competitors to attack, and harder for customers to abandon. That's why he was drawn to companies selling products people buy without thinking twice, like soda, insurance, and razor blades. These weren't flashy tech startups with unproven dreams. They were money machines with predictable cash flow and customer loyalty built over decades. Here's where discipline comes in. Most investors get seduced by hype. They hear about the next big thing and rush in without asking the hard questions. Buffett ignored hype like it was background noise. If a business didn't meet his criteria, he passed, no matter how much buzz surrounded it. This patience allowed him to avoid disasters that crushed other investors. He understood that owning part of a solid business is better than owning all of a weak one. And because he treated every purchase like a permanent marriage, he did more due diligence than anyone else. He read annual reports like novels, studied balance sheets like treasure maps, and understood a company's history before predicting its future. In his mind, a stock was not a gamble. It was a partnership with people running a business that would, over years, either create wealth or destroy it. That's why his portfolio wasn't cluttered with hundreds of names. It was concentrated with companies he deeply believed in. The lesson is clear. If you wouldn't want to own the whole business forever, you probably shouldn't own even one share of it. The stock market is a psychological battlefield. Every tick of the price chart plays with your emotions. Fear when it drops, greed when it rises. Most people don't lose money because the market is rigged. They lose because they react to every emotional trigger it throws at them. Its edge wasn't that he had some secret insider signal. It was that he refused to let emotions dictate his moves. When everyone else was panicking and selling, he was calm, calculating, and often buying. This wasn't luck. It was training himself to think like a chess player, not a slot machine player. He approached investments like long-term missions, not quick scrambles for cash. When the headlines screamed recession or market crash, he didn't join the stampede. He looked for the opportunities hiding in the chaos. That kind of discipline is rare because it means ignoring your gut when your gut is screaming at you to run. Discipline also meant knowing what not to do. It didn't wake up and make trades every day just to feel productive. He knew that overtrading was like overwatering a plant. You think you're helping, but you're actually killing it. Instead, he waited for the right moments to act, sometimes holding large amounts of cash until the perfect opportunity appeared. This patience drove other investors crazy. They wanted action, movement, excitement. But it was fine with boredom if it meant protecting his capital. He often compared investing to baseball without a called strike zone. You can wait for the perfect pitch for as long as you want, and you only swing when you're sure you'll connect. That mindset allowed him to avoid costly mistakes. He didn't chase fads, didn't fall for hype, and didn't buy just because everyone else was doing it. In his world, following the crowd was a shortcut to mediocrity, not success. But here's the most overlooked part. Discipline isn't just about patience. It's about sticking to your principles under pressure. Anyone can have a strategy when things are calm. The real test comes when your investments are dropping in value and fear is everywhere. Most investors sell at the worst possible time because they can't handle seeing red in their portfolio. Buffett leaned into those moments. When good companies went on sale because the market was in panic mode, he bought more. He understood that fear creates bargains and greed inflates bubbles. Staying rational when everyone else is emotional isn't just a nice skill, it's the difference between building a fortune and watching it evaporate. That's why discipline was his ultimate weapon. It allowed him to keep his head when others lost theirs, to act on logic instead of impulse, and to turn market chaos into lifelong opportunities. So here's the real takeaway. Wealth isn't built in a frenzy. It's built in layers. You start with a seed of capital. You let compounding turn it into a forest. You choose your businesses like you're marrying them for life. And you train your mind to stay calm when everyone else is losing theirs. This isn't about chasing every shiny object. It's about stacking smart decisions over time until the results are so big, people call it luck, but you'll know the truth. It wasn't luck. It was patience, discipline, and the relentless refusal to break your own rule. That's the playbook, and the only question left is, are you willing to play the long game? If you found this video helpful, hit the like button, subscribe, and turn on the bell icon so you never miss an update.